Good morning. It's 10:07 on a Friday. That means it's time for the Real Estate Fix with Rich Szerman. I'm your host, Rich Szerman, on KHTS 98.1 AM 1220, your hometown station. Thank you guys for tuning in this week. I appreciate it. As always, I am Rich Szerman. I am a realtor. I am not an attorney. I do not provide legal advice. The opinions I have are my own. If you do need specialties, realtor, accountant, whatever, attorney, please give us a call. I'll be happy to help you out. You can reach me two ways. You can reach me through the internet, which is thefixwithrich at gmail.com. That email address again is thefixwithrich, no spaces, thefixwithrich at gmail.com. Please send me your questions, your issues, whatever. I promise I answer every email. Even if they're from out of state, I'm happy to help you out. I guess people see this on YouTube, so that's great. Happy to help out, answer your questions. Been getting a lot of stuff lately on that. Also, you can call me on my cell phone. This is my personal cell phone. I do answer it morning, noon, and night. It's 661-714-1400. Although, Mom, if you're listening, I have pointed out I cannot answer your phone when I'm on the air. There's 1 hour a week when I'm just not available. So you have to text me for that. That's okay. Mom doesn't really listen to the show, so we'll be all right. Anyway, for those of you who are still listening, they've got all kinds of stuff. We're going to start today with a little bit of market updates. You hear what's going on in the real estate market. And then, oh my goodness, have I got one for you. I consider part of my job here, and being lucky enough to have a radio show, part of my job is that when I run across, and in my private practice as well, when I run across something that is just an unbelievable scam, just the kind of thing that curls your hair, you can't believe this is going on, I feel like it's my responsibility, since I have a little bit of a platform, to make it public, to let people know this is what's going on. And I'm going to tell you a little story about the We Buy Ugly Houses people, because we had a little to do with them a couple of years ago, and let's just say I was, as always, prophetic on this topic, because there's an article that just came out through ProPublica that is worth reading. It's a little long, but we're going to go over it today because, oh boy, is this a big thing. But anyway, let's start with market update. So basically, market is not a whole lot changed from where it was last week. The interest rate went up a tiny bit, not much, not enough so you'd really notice too much, just a little bit. Loans are still harder to qualify for than they were a year ago, but still, it's okay. And prices have bounced up a tiny bit. And let me just give you an example. I'm looking at, by the way, there's all kinds of good data out there if you bother to look for it. This is from the SCV Economic Development Corporation, which is a really good source for information. I like them a lot. And there are two things I want to talk about. One has to do with commercial property, because that is a harbinger of what is to come in the residential and the rest of the market. And the other is about residential property at the moment. So let's talk commercial property first, because this is a little bit of a concern. This is in the Santa Clarita Valley. The available office space in Santa Clarita Valley between Q4 of 2022 and Q1 of 2023, which you just wrapped up, has gone up a full percentage point. It was 17.77%, according to the SCV Economic Development Corporation. I have no reason to doubt them. And that's already very high, 17.77%. And now it's at 18.76%. It has gone up a full point. 18% commercial vacancy is a number that concerns me, and I think it's going to get higher. I also just read an article about the mall, the owners of the mall, theoretically walking away from the mall because they're going to default on a debt. What you see in commercial property tends to ricochet into residential and the rest of the economy pretty quickly. There's sort of the canary in a coal mine for a lot of this sort of stuff. And if you drive around town and you just look around, there's a lot of commercial vacancies available. I mean, a lot. I mean, I think traditionally we run around 5 or 6%, and now we're talking 18, 19%. That's too high, and I'm very concerned at what it's going to look like in Q2, because if the commercial vacancies remain as high as they have been, and that trend continues, I promise you the recession that we are already in will get worse, and we'll have to actually call it a recession. We can't just pretend we're going into one. If I hear one more report about we might go into a recession, I'm going to scream, because I hate to tell you this, we are already there. It can get better, it can get worse, but we are already there. So yeah, housing prices remain largely unchanged. I know I've been told I'm not supposed to use this phrase anymore, but I just love it. The economic term, the dead cat bounce. I love that phrase because I'm weird and I never heard it before. Anyway, now that just means that when a market is deflating, that it'll bounce up a little bit before it kind of deflates even further. And I have a sneaking suspicion that's what's going on in housing. I really hope that I'm wrong. I've been saying since the first of the year we're going to lose about another 5% in overall housing value in the residential market through 2023. And we've lost 10% since the absolute height in April of 2022. So we're already down 10%. Markets come back a few percentage points, which is nice, but it's going to go down a little bit more, I fear. Also, the other number to pay very close attention to is the number of home sales. And this is a little bit of good news. In February, this is in Santa Clarita Valley. In February of 2023, there were 199 sales reported. In March, there were 380. So more sales coming. I think that's really a matter of people responding, buyers responding to sort of the shock of the interest rate going up and then realizing, well, it's not coming back down. It was up at 7, it's come back down to 6.5, and it's probably not going to get much better. I think that's what spurred myself. I think it's my own theory that's what spurred a lot of the buying. But it's still much, much lower than in March of 2023. 2022, there were 531 houses that sold. So that tracks. The real estate market in general, buyers, sellers, all the way across the board on the residential side has decreased. I mean, just the market as a whole has shrunk. It shrunk 30 to 40%. 33% is the number I see most often, some as high as 40. But just there are 40% fewer houses being sold. There are 40% fewer houses being brought on the market, et cetera, et cetera. Now, as long as demand remains, decent, it has gone down, but at least as long as demand remains there, prices still have a shot at not going down the 5% that I'm projecting. So I really, like I said, would like to be wrong about this, but I'm not always right, but I'm right a lot more than most people, Maybe one of the reasons I got a radio show. I don't know. We'll see. So that's kind of the market is concerned. And as I've been saying for the last couple of weeks, I think it's going to get worse before it gets better. I think the interest rate is going to continue to creep up very, very slowly till the end of the year. And I think toward the end of the year, maybe the beginning of 2024, the interest rate will start to come back down a little bit. It's not going to happen in fits and starts, I don't think. I think it'll happen It'll happen sort of like a lobster in the pot, as the pot's boiling slowly. I think that's where it's at. I do think the Fed has done raising interest rates for a while, and I'm going to say that's a very, very good thing, because inflation has come down a bit. But let's talk about why I feel that way, because I got some really good data here from the nice people at NAR. We're going to talk about NAR stands for the National Association of Realtors, as opposed to the CAR, which is the California Association of Realtors, or the local board, which is SRAR, which is the Southland Regional Association of Realtors. Got a lot of associations involved in real estate, not to mention government oversight and stuff like that, which we're also going to discuss a little bit today. But anyway, NAR just had a really big meeting in Washington. It was quite the big deal. Had all of the best of the best experts out there. And of those, there were two of the nation's top economists, Doug Holtz-Eakin, who is the former director of the Congressional Budget Office, and Dana Peterson, who is the chief economist of the Conference Board. Both said that the national debt, because we're talking about the national debt and the debt ceiling, that is the next big watershed like 2 weeks from now. If that isn't sorted out, we're going to lose a lot more than 5% of the real estate market. But let's go on to what they said. What they said is that the national debt is unsustainable and projected to rise more than the size of the economy. They said that she's fearful that we'll go over the brink at some point, warning that everything shuts down if there's a debt limit breach. That shutdown cuts 6 percentage points from the GDP right off the top, ensuring an immediate recession, or I would say a deepening recession. The cost of borrowing would go up for all of your customers. Last we were talking about, there was I think it was Jamie Dimer from Citi. One of the experts was telling us that if we breach the national debt, interest rates will spike to 8.5%. They will go from the 6.5% that they're at now, which is problematic already and is already causing trouble in the market. They will spike, because if you mess around with the full faith and credit of the United States government, especially over a budget that has already been agreed to, if we default, we become a deadbeat creditor, a deadbeat nation, I should say, then a lot of what we do around the planet, a lot of the reliance on the U.S. dollar goes out the window. We're not supposed to be able to default. That should not happen. That's why we are the national standard. And if we monkey about over politics, we're going to have a big problem. And real estate's going to see it. Everybody's going to see it. But real estate's going to get hit super, super bad. Anyway, the reason this is a big deal is because there are two leading indicators of anything in real estate. And they are the interest rate, which we talk about a lot, and the other one is consumer confidence. Same economist said that the concern is about consumer confidence. When consumers don't feel good about what's going on in government, they are not likely to spend. If they do not feel good about what is going on in government, they are not likely to spend. Again, instability does not help most markets. Instability does not help most economies. And we really, really, really do ourselves a disservice by having a debate over a budget that was already agreed to now. Pay the bill. That's what needs to happen. However you guys need to get there and do it, that's up to minds greater than mine. Pay the bill. Do not default, because that causes all kinds of trouble that I'd have to deal with in my office. So don't default. Anyway, according to these two economists, who had a lot of good things to say. If you want to read their full remarks, you can get it at NAR's website. It's open to the public. But anyway, there is no right way to raise the debt limit. We have to do it, but getting it done is just a matter of politics. Very much what I was just echoing. They're going to run up to June 1st, and we're going to see financial markets react. Even the run up to it's going to cause a problem. They won't know what deal they want, so they will punt to do a short-term extension until September 30th, so we can get a second round of this. Also not acceptable. Kicking the can down the road on an issue this important, which shouldn't be an issue to begin with, it would be a disaster. It would be a very, very bad thing to do for an economy that has already been weakened by the Fed jacking up interest rates like a crazy person because they're worried about inflation. And I'm glad that inflation is getting curbed. I just don't know that this is necessarily the way to do that. And as further support for that opinion, There is a guy who I pay an awful lot of attention to. Whenever he writes anything, whenever he says anything, I perk up. He's the chief economist. His name is Lawrence Yun. He is the chief economist for the National Association of Realtors. Again, his name is Lawrence Yun. Y-U-N is his last name. You can always Google it. You should read anything he has to say as long as it's timely. Again, he's not always right either, but he's one of those 5, 6, 10 people that I pay very close attention to because he's the chief economist for NAR, the National Association of Realtors, and he's right most of the time. What he was just saying was that the Fed's aggressive rate hikes have hurt regional banks. We can see that by the 3 who failed, have hurt regional banks and the housing market. He noted that inflation has already started to calm, but rents on apartments and single-family homes remain elevated. In other words, driving up the interest rate with the Fed, that driving up the mortgage interest rate, the bond markets, etc., has calmed inflation, which is good, but it's really, really hurt renters because rental rates are still up. Anyway, and according to Yun, inflation will not reignite. Inflation will come down close to 3% by year's end. Remember, the Fed's stated goal is 2%, so I don't know how they're getting there, but hopefully 3% will satiate them. The inflation has calmed down while rents are still accelerating. His basic premise is that the last round of rate Fed hikes, and I can't help but agree with the man, they were unnecessary. They didn't really do a whole lot to help. They were just, they created a roadside marker that everybody's going to have to deal with. There's only the mortgage markets and the bond markets and the stock market are only going to keep the interest rate so low for so long. I believe it's going back up. But according to Yun, apartment construction is up, which is good, and that's reached a 40 to 50-year high. The problem is we're now building more apartments and not enough houses. So we're creating yet another, differentiation between the rental class and the ownership class. There shouldn't be that much of a differentiation between the two. The whole idea is, in the American dream, is you rent until you can own. But by doing this, I'm afraid that we're going to create a situation where we have more renters than we have owners. We're 44% renters in this state now, and that's way too high. That's almost twice the national average. It is not healthy. We cannot have that many renters and that few owners in this state and expect that to be sustainable, because it just isn't. But again, Yun said rent growth will decrease because apartment construction, his idea is if enough more apartments come on the market, rentals will decrease, or the rental price will decrease. Entering units coming on the market is already in the pipeline. In other words, everything that's being built already has people waiting in line for it. We're already moving in the right direction, but it's going to be a decade or more before we're out of it. Yun said that new home sales are back to pre-pandemic levels. However, existing home sales are historically low. Current housing inventory is down 40%. Just talked about, compared to 2019. The housing market is being held back by a lack of housing inventory. Like we talked about last week, and we'll continue to talk about, people who refinanced during the pandemic, like myself, who got interest rates sub 4, below 4%, aren't in a hurry to sell. Freddie Mac and Fannie Mae tell us that fully 70% of every single-family home in this country, 7 out of 10, now has a mortgage rate under 4%. Or 4% or under, to be exact. So if you got a 4% mortgage rate, why would you sell and go into a 6.5% interest rate if you can avoid it? So there's not a lot of people who are move-up sellers and things like that. Part of the market's being really, really held down. But so yeah, it's great to hear that home sales are getting better, but we are still by no means there. We're just not. There just aren't enough houses on the market. Their houses aren't coming to market. There are whole segments of the real estate market that are just not moving, and they're not going to move anytime soon. The economics just determine that. That's just the way it is. But anyway, same two economists said the supply side factors that pose a challenge for builders. This is important when it comes to building new houses. This is why new houses aren't coming online as quickly as they should. Building material costs have gone up a lot. The good news is the materials are down 1 to 2% cheaper. The bad news is there's less demand for building, not from the public, but for building supplies, because builders aren't building houses as quickly, get them on the market as quickly, because they're worried about a recession. Even in a state like California, which we have a massive housing crisis, they literally cannot build them fast enough. But when they build houses for sale, there's a cost to the builder to doing that. The builder needs to make a profit, and if they don't have buyers lined up to buy them, because 6.5% interest rates are not as good as 4.5% interest rates or 4% interest rates, they're having trouble moving them. I mean, right now, new housing sales are doing just fine, as are resales, because there's not a whole lot on the market. But I don't know that that's going to last, and it's certainly not a recipe for getting more houses into the market to curb the housing crisis. And that's what concerns me more than anything else. But anyway, their final conclusion here is that it's basically this stuff with the Fed is the interest rate. The Fed has made it more expensive to build, made it more expensive to develop. Regulatory costs also inhibit housing improvements. So we got all kinds of trouble on that end as well. So yeah, I mean, it's nice to hear what economists have to say. It's nothing we haven't talked about before, that's for sure. And I definitely like reading what Lawrence Yun has to say, because like I said, the man is usually right about what he has to say about the economy and where it's going. And we have some stuff from CAR as well, from CAR, that's telling us that home purchase sentiment improves as consumers' optimism on mortgage rates amend. People are getting used to the mortgage interest rate at 6.5%. It doesn't mean it's a good thing. It just means people are getting used to it. Now, they're also saying that mortgage delinquency rates have declined in the first quarter of 2023. Again, that was just the first quarter, and that's because there were still a lot of people who were able to do refis, which is the end of that quarter they cannot do. So I would expect those rates to start going up again as well. But again, this is the big number. Consumer sentiment slumps in May. According to CAR and NAR both, they're both now telling us that consumer confidence has been shaken quite a bit. Even though people are still buying houses, people are still selling houses. It's not the pandemonium we saw in 2008, 9, and 10. But at the same time, it's all about consumer confidence. When consumer confidence weakens, coupled with the interest rate going up, that is not a recipe for a healthy real estate market. That is a recipe for disaster. It doesn't necessarily guarantee it, but we are in the danger zone as far as that is concerned. So consumer prices still remain, according to California Association of Realtors, consumer prices still remain elevated but continue to ease gradually. Not in our area. Our area prices are not going down. They're going up a tiny, tiny bit. Yeah, it's people are paying more to live in houses. This is the big conclusion here from CAR's latest meeting. This goes back to May 15th, is that, which is a few days ago. It goes back to it's nice that consumer prices remain elevated, but the problem is housing for most people usually cost them about, not excluding food and energy, just housing cost was about 5.5% of income on average. Again, that's a lot of people who are a lot more money. Most housing costs is closer to 15-20%. But this index in order to 5.5. The number here that's important though is it's saying it went up in the last quarter to 7.5. That's a 2% increase in what people are having to pay on average, according to this one index, for housing, and that's just way, way, way too high. So yeah, we're in dangerous waters. It doesn't necessarily mean that there's a definitive crisis coming. It just means there's one on the horizon if we're not careful. So that's kind of where the market is at the moment. And there is something I want to talk to you guys about that's very, very interesting and near and dear to my heart. It has to do with those We Buy Ugly Houses people. For those of you who are readers, there's a great ProPublica article that just came out about this. We're going to go to break now. We're going to get some bills paid, talk to hear from some advertisers. We like to do that sort of thing. The station really likes when we do that sort of thing, obviously. When we get back, we're going to talk about the We Buy Ugly Homes people and why that is just a scam that I'm sorry it's hard for me to even talk about without getting angry. I've had my own go-rounds with these people and files I've had in my office, and this article just called them out because what they're doing it's wrong. It's unethical, it's immoral, it's wrong. And when we come back from break, I'm going to tell you exactly why. My name is Rich Szerman. This is the Real Estate Fix with Rich on your hometown station, KHTS 98.1 FM or AM 1220. Come on back. Hi there. Welcome back, everybody. You've reached the Real Estate Fix with Rich Szerman on KHTS 98.1 AM 1220. Thank you guys for sticking around, and for those of you who just tuned in, thank you for tuning in. I promise you're going to like this. This is a good one. I'm going to do my best to get through this story. I told you at the top of the show we were going to, whenever I see something that's fraud, or I consider fraudulent or bad actors or just immoral, unethical, horrible behavior in real estate, and there's no shortage of it in my industry, unfortunately, we seek to stamp it out, but it's still there. And I ran across one that we just got to talk about it. And I'm going to do my best to talk about this without getting angry. There's a giant sign in front of me that says, please do not curse while on the air. I'm going to do my best to stick with that. I promise I will not curse, but when you hear this story, you're going to want to curse yourself. So there is a company out there, you've probably seen their advertisements on TV. There are a lot of these companies, but the biggest one in the country is called HomeVestors. HomeVestors is the guys who do, HomeVestors of America, pardon me. They're the guys who do the We Buy Ugly Houses. They have a little caveman as their mascot, and We Buy Ugly Houses. And their whole premise is that if you have a house that's damaged or beat up or whatever, we'll buy it instantly. We'll close escrow super fast. We'll pay cash for it, and yeah, you'll sell the house for a little bit less. But we're doing it out of convenience, and to save yourself all this trouble, it's going to help you out. That's their operating premise. Now, why that is complete and utter garbage, if you haven't figured it out already, we're going to go through today. Now, first I'm going to tell you a story I had with them. This is personal to me. This is in my office. 2020, just before the pandemic started, maybe it was the end of 2019, bleeding into 2020. Anyway, had a client come in because his elderly father had a house in Canyon Country, and his dad, just before he died, entered into a contract to sell the house. And he entered into a contract to sell a house in Canyon Country, built in the mid-'80s, around 1,900 square feet, for $200,000. I don't care if that house had burned to the ground and there was nothing left but a burned out husk. It's still worth more than $200,000 in Canyon Country. It just is. And part of this is people do this. They get in trouble, they get panicked, and they make bad decisions. His father he knew he wasn't doing well. And he knew he was going into hospice care, and he knew he was closer to the end than the beginning. And I think he made a very poor decision to try to help his family. Unfortunately, he got mixed up with these we buy houses for free people, and they took advantage of it. They took advantage of a elderly man who was not in his right. He didn't have control of all of his faculties. He was going into managed care, and they ripped him off. I don't know how else to put it. I view this as theft. When you get into a contract with somebody who lacks the resident capacity to understand that contract, and that's theft. You're taking advantage of someone. That is theft, in my view. So in this particular case, my first thought was, well, obviously he lacked the capacity. They're not going to, come on. He's in his 80s, for goodness sake. Come on. So I called up the company, which is mentioned in this article, in LA, who works with these they're a franchise. Homevestors is a franchise. And I told them, hey, this is what's going on. Obviously, you can't do that. You need to reverse it. And their immediate response was to file a lis pendens on the property, refuse to reverse the sale, and say, no, we're buying this house for $200,000 because we know we can flip it for $600,000 or $700,000, and that's our money. Really? Because I think until you scam this guy with a really bad contract under bad circumstances, that was his money. That was his money that his family needs to pay for his care for the rest of his life. It is not your money just because you scammed somebody out of it. You can imagine how that ingratiated me to this company. And we had a giant fight about it, and we went to our respective corners, and it got really ugly for a while. And we got the house back. We got it done. They agreed to back off. No small task. We had to threaten them with everything short of death in order to get this done. And we got it done. It was basically, if you want to go down this route, I'd love to get in this fight, and I'd love to make it as public as possible because you guys are wrong, and people need to know what you're doing. And I didn't sign an NDA or anything, but we agreed that we would just go to our separate corners. They'd give this guy back his house, or his family, because he'd passed away, back his house. And then by the time this got wrapped up, he'd passed away. Back his house, and they can sell it for what it's worth. And they did. They sold it for $800 and change and got the money out of it, etc. And my last thing I said to these people, the last thing I said to them before we wrapped up this file was, someday, somebody who's got a lot more juice and a lot bigger platform than I do is going to call you guys out on this stuff. And I hope when it happens, it burns the company to the ground, because what you're doing is wrong. In this case, you are taking advantage of an elderly man who lacks the capacity to make a good decision. He had family members who were taking care of him. He told you. I know that because they told me that in writing. They had talked to his son. They just didn't want to give up the contract because they're going to make money. Their entire business model is based on abuse. I don't know how else to put it. I would say their entire business model is based on abuse. Now let's talk about and this is directly from their website, WeBuyUglyHouses.com. So this is what they're telling you. We help people in Los Angeles get a fresh start from tough situations. Do you have structural issues with your home? Are you facing foreclosure? Are you facing relocation or job transfer? Do you live in an undesirable neighborhood? Are you in the middle of a divorce? Do you need cosmetic fix-up? I don't know what that means. Are you retiring or downsizing? Have you experienced the death of a loved one? Trust me, that one's highlighted because that's what they look for. Are you just looking to liquidate assets to pay bills? Did you inherit a property that you can't keep? Are you tired of living in an ugly house? Do you have troublesome mortgage terms? Have you lost a job? And many more. In other words, if you're in economic peril, if you're at the worst point in your life, if you are in trouble, come on down. We're going to help you out. It's a lot of the pitch that they, maybe this is why it gets me particularly angry, a lot of the pitch that they use to attract people are often my clientele. The difference is I help people for free. I don't buy their homes. I get their situation sorted out. Usually we keep the house because that's what they want to do. We do loan modifications and write-downs, and sometimes people have to go into bankruptcies and other things. Sometimes it's a lawsuit. But I serve, my team and I, as counsel for these sort of things, not legal counsel. My wife would be happy I explained that because she is an attorney. She gets to serve as legal counsel if it becomes necessary. But our goal, and again, we do this for free, so our motivation is not in question. Our goal is to sort these things out so that people don't have to sell their houses. Now, sometimes you do. Sometimes there's no way, you have no income and you got, $6,000, $7,000 a month mortgage. We're probably not going to be able to save the house. But the vast majority of the time, our numbers in my office, 80% of the time, we are able to find a permanent solution that keeps the family in the house. 80% of the time. I'm annoyed that there's a 20% failure rate, but to every life some rain must fall, I guess. But these guys, these We Buy Ugly Houses guys, their central premise is that, well, you're going to lose the house anyway, so you might as well sell it to us quick because we're doing you a favor. And goodness knows if you try to back out of one of their deals, whoa, the nightmare that is. So there's a great article that everyone should read. If you own real estate, if you rent real estate, if you live in a house, you should read this. ProPublica, who, again, they do not have advertisers as far as I know. They do this as a public service. It's kind of their whole thing is to expose corruption, and that's really what it is. So I'm just going to read you some of this article. It's called The Ugly Truth Behind We Buy Ugly Houses, and it's a fantastic article, and it really should put an end to this company, I'm hoping. Although it's a nationwide franchise, they operate in 48 states, so we'll see. Anyway, Homevestors of America, self-proclaimed largest home buyer in the U.S., trains its nearly 1,150 franchises to zero in on homeowners' desperation. Do they ever? So this is a story, and this is very akin to the story I went through, except it's a little bit more on task. So there's a fella. His name is Corey Evans, and he was well-versed in the Homevestors of America playbook when he arrived at suburban Los Angeles. So this Corey Evans is the guy there. Home on November 4th, 2016. His franchise with the We Buy Ugly Houses company had executed more than 50 deals in the previous 2 years. Patriot Holdings, which is the name of the company, it's Patriot Holdings, owned by Corey Evans and 4 other people, I think 5 other people, and they own a franchise for ugly houses from Homevestors. Anyway, Patriot Holdings would soon become one of the company's most successful franchises by following Homevestors' strategy of finding homeowners in desperate situations, then convincing them to sell quickly. Okay. Homeowner Corinne Casanova had bought a 3-bedroom Baldwin Park bungalow, and this is in Los Angeles, Baldwin Park bungalow, with her husband in 1961 and now owned it outright. So she had no mortgage and a lot of equity. After raising 3 children there, she was days away from leaving it for an assisted living facility and had called the number on a Homevestors ad. This is a quote from her, I was wondering if I could get an estimate on the value of my home, she told the woman who answered the phone. My husband's gone, so it's just me now. Now, when Homevestors gets a call like that, they start to salivate. I promise you they do, because what they're thinking about is, we got a good one here. Evans, who ran the business with 3 of his brothers, had developed a reputation among other franchises in the area as a hard closer. You'll see what that means in a minute. Casanova's house was paid off, giving Evans room to go low with his offer because there wasn't a mortgage to settle. He calculated the profit he wanted to make and presented Casanova with a 10-page purchase agreement during the short visit to her house. I don't know too many people, I'm sure they exist, but I don't know too many people who are heading into managed care who should be looking at a 10-page real estate sales document on their own. Frankly, I don't know anyone who should be looking at a real estate sales contract on their own. You should have a licensed realtor. By the way, had she contacted a licensed realtor, all of this goes away. None of this happens. Because as realtors, speak for myself, as a realtor, I am licensed. There's oversight of what I do. I have to answer to the Southland Regional Association of Realtors, which I'm happy to. I have to answer to the California Association of Realtors. I have to answer to the National Association of Realtors. I have to answer to the California Department of Real Estate. And I have to answer to the DA, which is fine. That's 5 levels of oversight, 5 different organizations that I have to answer to as a licensed realtor, which is fine. The whole point is that when you have a license, there is oversight. These guys operate without licenses. They intentionally do not get real estate licenses because if they did, there would be some oversight. They would have a fiduciary responsibility to the seller. In other words, I am not allowed to rip off a seller. I could not go to Corinne Casanova and essentially buy her house for pennies on the dollar and rip her off. These guys can, because they don't have real estate licenses. That's not to say that if somebody has real estate licenses, they can't act as a reprehensible, I was going to curse there, bad person. Insert your own curse, I guess. Because they do. But at least if they do, they get in trouble for it eventually. Again, we can talk about whether the oversight is strong enough or whether it's enforced enough. That's a whole separate show. But at least there is some oversight where there isn't with these home buyers. Homevestors and We Buy Ugly Homes and all the other, I'm Doug Hopkins and I buy houses. We all selling those commercials. And if an investor is looking to buy your house, they have a profit margin. Whatever convenience you are getting out of selling their house quickly, I promise you, you can get more money out of the house, get as much convenience as you need, handle everything by hiring a licensed realtor. Calling somebody off television or a billboard it's not a good idea when selling your house. It's just not. Anyway, so these guys, he's a hard closer. He ran the business with his brothers. She signed a 10-page contract. Casanova was incapable. This is the gal who's selling the house, Corinne Casanova. She was incapable of engaging in complex negotiation. Although she was once a skilled bookkeeper and president of the local women's club, dementia has now carved into her short-term memory. A recent neurological assessment of her had found that the 82-year-old was unable to say what year it was or the name of the city she was in, and she routinely took her adult son for his uncle. This is somebody they entered into a contract to sell her house at bargain basement prices for. Should be ashamed of themselves. Homevestors does caution its franchisees never to take advantage of the sellers. Sure they do, unless there's money to be made. Who are unable to understand negotiations. By the time he left that evening, Evans, from Homevestors, had a contract to buy the house for roughly 2/3 of its value, signed by Casanova in her shaky script, but she was able to sign it. Weeks passed before Casanova's family learned of the sale, but her son David Casanova soon sensed that something was wrong. After we moved her, she kept saying, after they moved her, she needs to call her friend, she needs to call her friend. And her son kept asking, Mom, what friend? And she couldn't remember. Again, this is the person they just talked into selling her house. Family didn't know she'd sold it. Once David, her son, learned of the contract, he explained to Evans that his mother had dementia and tried to cancel the sale. Instead of walking away, Homevestors dug in. They recorded a notice on the property's title that essentially prevented the sale from anyone else, which is called a lis pendens. And they were trying to force execution of the contract to buy the house at bargain discount prices. So the family entered into a years-long battle to save the home. Along the way, Evans, which disputed that Casanova showed signs of impairment during their interaction. I've seen the contract. It's in the thing. That's not a signature. It looks like a 4-year-old trying to learn how to write their name because she was suffering from dementia. But these guys are going to argue that she was fine to sell her house. Homevestors of America boasts that it helps pioneer the real estate investment industry. It was founded in 1996 by a Texas real estate broker. The company's developed a system. I love it when there's a system for snapping up problem properties and expanded it to nearly 1,150 franchises in 48 states. Isn't that impressive? Unlike real estates, however, house flippers like this operate under a largely unregulated space. Real estate agents have, what were we just talking about? Real estate agents have a fiduciary responsibility to represent a homeowner's best interest in negotiations, which is defined by state and local laws and licensing requirements, and an industry code of ethics. But in most states, flippers like this do not need a license. You don't need a license to buy and sell real estate yourself. You do if you're brokering it for somebody else, but if you're buying it yourself, you don't need a license. Homevestors tells their people to treat every customer like it was their 85-year-old grandma who has never done a real estate deal. Yeah, I'm sure that's Homevestors. That's why their franchises are so successful, because they tell everybody to be honest with elderly people and don't take advantage of them. Don't take advantage of something else, because lower your profit margin out of the good of your heart. I'm sure that's a part of their business model. All evidence to the contrary. Homevestor franchises has used this deception and targeted the elderly, infirm, and those so close to poverty they fear homelessness, and that is who they're looking for. That is who they're looking for. One Homevestors franchise falsely claimed to a 72-year-old woman suffering from a hoarding problem that the city code of enforcement officers would take her house. An Arizona woman said in an interview that she was forced to live in her truck after trying unsuccessfully to cancel the sale of her home. One court case documented the plight of an elderly man in Florida who was told if he sold his condo, he could continue living there temporarily. But after he spent his final days alive waiting to be evicted. When the contract was signed, the franchise owner said, "Oh, I'm sorry, the homeowners association won't let you stay here because you don't own the house anymore. So even though I told you you could stay here and you live out the rest of your life in this place, yeah, now you have to go. Sorry, it's the HOA." I don't even know where to start with that line of thinking. Even when homeowners believed they were being taken advantage of and tried to back out of the deals, franchise owners sued or filed paperwork to block the sale to another buyer. Same thing happened in the case I had. Some homeowners fought for hospital beds, literally from their hospital beds, to keep their properties. If you have a homeowner fighting you from their hospital bed, you're on the wrong side of the argument. At least 3 died shortly after signing sales contracts. A 4th died after 3 years of worrying about money. Their families all told ProPublica that they are convinced that the stress of losing these houses contributed to the deaths of their loved ones, though all had been ill or infirm to begin with. Quite sure it accelerated their deaths. That kind of stress would get into anybody. Homevestors spokesman, however, said that the deals uncovered by ProPublica represented a tiny fraction of the company's overall transactions. We should feel good about that. We only kill 4 or 5 people this year. We don't think of all the people we don't kill. That's sort of a murderer's excuse. Absolutely ridiculous. It's only a small part of their overall transactions, which have totaled more than 71,400 since 2016. I do not for a second believe that Homevestors has done 71,400 deals since 2016. And if they have, I wouldn't be proud of that. I'd be ashamed and scared, because that's 71,400 people who, in my view, got ripped off. She denied, of course, that the company does anything wrong. Within days of receiving questions from ProPublica, Homevestors prohibited its franchises from recording documents to prevent homeowners from canceling sales and discouraging them from suing. Which sounds good until you hear why. According to Homevestors, if we engage in this practice, it not only affects the seller, It creates a paper trail that reporters and prosecutors can follow to a franchisee's doorstep. So don't file lawsuits anymore because you might get caught. We like the kind of scam where nobody notices. Harder to get away with a scam when there are court records. My gosh. This is their excuse. This is their reasoning. So, yeah, these people are absolutely ridiculous. And we're going to go to break here because I noticed by the clock on the wall, it's time to do another break. We'll have some more commercials. But when we get back, we're going to talk about how to defend yourself from these people and how they find you and who they target and why. Every bit of this is reprehensible from the top to the bottom, and there should be government activity on this. There should absolutely be government action against these people because you can't leave it to the homeowners. So I'll try to calm down a little bit during the break. When we come back, hopefully I'll be a little less angry, and we can talk a little bit more about home investors and what they do in their practice and how to defend yourself from them. I'm Rich Szerman, and this is the Real Estate Fix on KHTS 98.1 FM. Welcome back. You've reached the Fix with Rich, should be calling it the Real Estate Fix, I suppose, with Rich on KHTS 98.1 AM 1220, your hometown station. My name is Rich Szerman. I'm your host for the hour, and we like to fix real estate problems around here. We like to fix people's problems, and I'm hoping to prevent a few problems by calling attention to this. We've been talking before the break about the lovely people at a company called Home Investors, otherwise known as the We Buy Ugly Homes people, and they are one of the larger companies out there, but they are emblematic of all of these investor companies that are out there. They prey on the weak, they prey on the vulnerable, they come along when you're at your worst, and they steal from you. They take the equity from you that rightfully you have earned because they con people into, and I will absolutely call this a con, they con people into selling houses under circumstances they otherwise would not. But let's talk about some of their business practices because I think this is very illuminating as to how they think and how they behave. One of the chief things to pay attention to with home investors is how they find people. How do they find these people to rip them off? Home Investors deploys a strategy that is completely morally bankrupt as far as I'm concerned. You will find their little caveman guy, their little friendly cartoon, which is trademarked, by the way. You'll find that little ad on homes that have been slammed by hurricanes, charred by wildfires, on mailers blanketing zip codes with high concentrations of homeowners who have lots of equity. Postcards sent to people that are public records indicate their home that have been recently divorced, that have recently died, that are currently in foreclosure, that are in probate. These are all public records, and they mine them. In recent years, scores of homeowners have complained to local authorities and Federal Trade Commission about Home Investors' ceaseless overtures, sometimes claiming that the company has ignored formal requests to stop. In one instance, a Texas resident whose father had recently been murdered told ProPublica that Home Investors wouldn't take no for an answer. The letters were so persistent, she said, that checking her home mail became a traumatic experience. I guess she didn't like getting letters addressed to her dad after he'd been killed. But didn't stop Home Investors, didn't stop the We Buy Ugly Homes people, because after all, there might be a buck to be made in getting his house, right? Home Investors cast its online net hoping to reach homeowners before they talk to a real estate agent or other investor. Before they talk to a real estate agent. This is key to their business model. This is what they tell their franchisees. You got to get there when the hurricane is blown through or the divorce is going through or they're in probate or somebody died or they're getting divorced or whatever their problem is, you need to get there before they get competent counsel. You need to get there before they talk to a realtor. You need to get there before they talk to an attorney. You need to get there before they realize what their house is worth. Because if they know and they understand who Home Investors is, you might not be able to get a deal out of them, which means you might not be able to rip them off and make yourself hundreds of thousands of dollars. I will have to cry a tear for them. Key to their business practices. Get to there before they talk to a realtor. That ought to tell you a lot. ProPublica went on, they found some former employees and they talked to them. And one employee was telling me that there's a advertising agency that they work with that bragged about their ability for its digital advertising to find an elderly person who had broken a hip. And I quote, "That injury, in effect, is a 60-day countdown to death and possibly a deal." So if you've broken your hip, Home Investors wants to talk to you because according to them, you'll be dead in the next 60 days and boy, they better get to you before you pass away or talk to somebody competent. And I quote, "If we get in front of people's, at this point, it was like a definitive way to go," the former employee said. "It was bad. I didn't like doing it. My stomach hurt." Still did it though until you quit, didn't you? Lord. If your stomach hurts, if you work for some place where it turns your stomach to work there, quit! Go someplace else. My Lord. Yeah, let's move on. So anyway, Home Investors have taught their franchises to find people look for people moving into nursing homes. That's super valuable. If they're moving to nursing homes, that's us. The company's training manual teaches franchisees to build relationships with those who interact with people in difficult situations, nursing home administrators, probate officers, divorce lawyers. It also instructs them to comb neighborhoods for clues of distress, water shutoff notices, police tape, boarded up windows, burn scars. burn scars. If your house is burnt down, they want to talk to you because they're here to help. My Lord. Their favorite, though, is if a family's belongings are on the curb, because that's the directive in the training manual. If you see stuff on the curb, quickly pursue the property where there's a trash pile indicates eviction, because you're their kind of client. They do a pretty good job scrubbing the internet and managing their websites and everything else, but regardless of its scrupulous image, the company has times described its targets in crude terms. Certain homes in its advertising crosshairs are referred to internally as honeypots. They're looking for a honeypot, oh boy. And in a 2020 interview, one of the people targeted his company said he's looking for houses that smell so bad that they want to take a shower after they leave. And I quote, this is from a HomeVestor franchisee, "That cat piss smell, you know what that smell is. That's money." So if your house smells like a litter box, they want to talk to you because they'll make money there. It also wasn't just one bad franchise. This is how they operate. They are trained, and this is a direct quote from their training manual, to find the pain. That is how they train people. That is their secret recipe. Find the pain. Find what they're worried about. There's one here that they talk about, which is so emblematic of this. A woman in Fort Worth, Texas said in an interview a franchise told her she could legally sign a contract to sell her late husband's house even though she wasn't on the deed. That is a lie. A man in Broward County, Florida believed he was signing a document for a home equity loan. In reality, it was a contract to sell his house for $100,000 house for $37,000. I'm going to call that a lie, according not what the guy said, but what the company did. According to a lawsuit he filed, but ultimately abandoned, because people always abandon these lawsuits. A woman in Arizona said in an interview she was told her late mother's home in a popular outdoor recreation area town would have to be torn down and rebuilt to fetch a fair price. After paying $10,000 for the house, HomeVestors turned around and sold it for $55,000 without making a single improvement. But they were telling her it had to be torn down because, they can only pay $10,000 for it. It has to be torn down, you see. Again, lie. They lie to people. They're licensed, they can, I guess. They can be totally unethical, totally immoral, and it's profitable for them. HomeVestor spokesperson said, such behavior isn't taught or tolerated. When it's found, we aim to take swift action, and including termination of the franchise. Lying is against our code of ethics. Yeah, if you believe that, I guess HomeVestors wants to buy your house if you believe that. Yet after saying that, HomeVestors bestowed awards on 8 franchise owners in the last 2 years, all of whom engaged in this behavior, all of whom the company said is not tolerated. And yet they're giving them awards. Sounds good. HomeVentures teaches, as we were just talking about, to find the pain. The pain is what you're looking for. Pain is always a form of motivation, the training manual reads. Once you find the seller's pain, you have a much better chance of buying their house. Find what they're worried about, find what they're afraid of, and take that house. Among the circumstances that can generate a fast sale, a lost job, a looming foreclosure, a child in need of surgery. If your child needs surgery, they find out, they will buy your home at a discount price so that you can afford to get your kid's surgery. My God, I don't even know where to start. My God, is this immoral? One former franchise described how he found a potential Atlanta seller's pain by asking the homeowner why he needed to sell so fast. The homeowner's answer? His mother was living out her final days in hospice 1,400 miles away. He just wanted to go see his mom before she died. So they took advantage. It's not because they want to sell the house, the former franchise owner said. It's because they want to get to Colorado to see their dying mother. So not only did this person, again, I'm trying real hard not to curse, did this person from HomeVestors know this and take advantage of this, he was proud of it because he talked about it at their conventions. I got this guy who I found his pain because he wanted to get to his dying mom before she passed away, and it was 1,400 miles away, so he better sell his house to get to that. In the Casanova case, the one we were starting with, we'll wrap up the show here, the appraisal put the house's value at about $500,000, which is well above the $165,000 they were being offered. Now this guy, because he was pissed, and I totally applaud him for seeing the lawsuit through, he actually got him. He beat him. He beat him. He got him to give back the house. He got him to they paid restitution. And unfortunately, there's no real criminal action that can be taken. So these guys are right back doing it. This is disgraceful as all heck. This is horrible. There needs to be a federal law to prevent this. It is that simple. That is how you stop this. You get a federal law. There has to be some public will to do this. a federal law that prevents this kind of flipping. There are many ways to do this. And if you're a politician and you're out there and you're listening to this, I will be more than happy to give you a tutorial on this subject. I don't expect you to understand it. This is my field of expertise. I know a lot about it. I will be more than happy to let you know. Call me anytime. We'll talk about this more next week, hopefully. Again, my name is Rich Szerman. This is The Fix with Rich on KHTS. I want to thank you guys for listening. Sorry if I was a little angry today, a little more animated. I just get really angry when people take advantage of people they have no right to do this to. My name is Rich Szerman, and this is The Real Estate Fix. We'll see you again next week. Thanks for listening. Bye-bye.